In the global financial markets, it's often these tiny changes in the words used by world leaders that marks the biggest shifts in policy and markets. And this week, that is exactly what we've been seeing, with some ridiculous changes in Japan in particular. Now, I already made an entire video explaining Japan's return to Abenomics, with stimulus checks being sent out to Japanese citizens to try and boost the economy. And there is a far more important topic at hand, which we're going to cover today: the yen carry trade, a $20 trillion financial staple that's lasted decades but is now finally unwinding. And as it unwinds, global financial markets risk falling down as well, as they have been propped up by this supposed risk-free trade for years on end. So today, we're going to break down exactly what is happening. So it starts off with interest rates. The Bank of Japan is likely to raise interest rates in December, with the government expected to tolerate such a decision. The Bank of Japan is expected to proceed with a hike from its policy rate to 0.75% from 0.5%, and it would be the first hike since January. It is getting more and more increasingly likely that we're going to see this 25 basis point rate hike by Japan over the next week. And that's very important because it will result in the highest interest rate that Japan has seen in well over a decade, despite not actually being a high interest rate compared to global peers. Currently only sitting at about 0.5%, and that's still leagues below somewhere like the UK or the United States. But Japan has been the loosest monetary and fiscal government for the entirety of the last 2 decades, even more addicted to that free money machine than the United States. Now, Japan have only been able to have such loose monetary and fiscal policy because of their pretty stagnant economy and their incredibly low inflation rates. Japanese people just don't spend that much money. They don't like to personally borrow much money. They don't like to personally invest in new businesses or new technologies. They are incredibly risk averse as a culture, and the economy is rather stagnant and has been as a result. And on top of that, aging demographics means that there are fewer productive people and more elderly living on pensions and family support, dragging the economy down. That basically means that even when interest rates are negative and the government has been printing money and giving away willy-nilly as they have done over the last couple of decades, that often isn't enough to spike demand enough to cause inflation, or at least that has been the case for the last 2 decades. So even with almost infinite money printing, Japan always had rock bottom inflation numbers, and sometimes even dipping into the very, very dangerous deflationary environment. And what this did is it created an economic environment where easy profits could be made through something called the yen carry trade. Let's say that interest rates in Japan, just for a moment, were back at 0% as they had been for decades. And that means that an institution could borrow yen at an incredibly low interest rate. That institution can then convert that yen into US dollars and invest those US dollars into something that gives it a much higher yield. Typically, this is going to be something relatively low risk, like high-grade corporate bonds or US Treasury yield. Go back then 2 years and Japanese corporations could borrow yen as low as 0.1% per year. So let's say they borrow $1 million worth of yen at that rate, and then they convert it to US dollars. Now they have dollars, they enter the US debt market, they invest it into, say, US 2-year treasuries at a yield of 5%. They keep the bond for 2 years. They get paid out, $100,000 in yield on the $1 million in bonds they bought, and that's about 10% of profit on that investment. Then the bond matures, they get the full $1 million back, they convert it into yen, and they pay back that original yen loan. They invested, actually on their own behalf, $0 into this trade, yet they walked away with $100,000 in profit. And that profit from the yen carry trade was basically equivalent to the difference between interest rates for those two markets, for those two different currencies. And over the last few years, the difference for US dollar denominated debt versus yen debt had been around 5%. But again, the big differentiator here is that you don't have to put up any money yourself to partake in the yen carry trade. And so this isn't a 5% return on a trade over a year. It's a 5% return on the capital that you risk, of which none of it is yours. So in a way, the percentage profit is infinite. Now, how much money had actually been involved in the yen carry trade in recent years? Well, a market research firm called TS Lombard estimated that the yen carry trade was worth about 1.1 trillion US dollars per year. The Bank for International Settlements, which is typically, or basically the global central bank for central banks, They put the number at 2.2 trillion US dollars per year. That's 2.2 trillion US dollars worth of value of wealth printed almost out of thin air, turned into US dollars, which adds huge value to the US dollar itself because that's a lot of buying pressure and demand, and that's then being invested into essentially debt or assets in the United States. Now, mostly the yen carry trade was involved with US treasuries, but plenty of that money also flooded into US corporate bonds or private credit or even stock markets or property investments as well. This, for decades, had massively inflated asset prices in America. It reduces the cost of debt and it funnels profits overseas to Japan, but it isn't productive profit or real increases in wealth. The increase in asset prices here is not being created by someone coming up with some innovative new business. It's been created artificially by the Bank of Japan, keeping interest rates in Japan artificially low, whilst the US allowed their interest rates to sit closer to a true market price. No asset is more productive, no person is more efficient or profitable or business more profitable than before. Things are just valued higher because there's more demand being flown in artificially from abroad. Now that's kind of fine on the surface when the yen carry trade is working and it's continuing and it's not going to disappear overnight because that demand continues as well, which means that those asset prices that went up in the past, they're going to keep going up in the future, and who cares if it isn't real or based on any, proficiency or efficiency gains or fundamental changes. It's still accessible, it's still wealth increases in the United States. The US government, they're still getting access to cheaper debt and stock prices are still going up for me and you. And that's true. This is all fine and well, and the yen carry trade isn't a problem at all whilst the yen carry trade works. But in the same way that the carry trade inflated all of the values of assets in the United States and made debt cheaper whilst it was working, when the carry trade stops working, the opposite will happen. That capital, that wealth will flood out of the US financial system, out of US bonds, out of US stock markets and property, and asset prices will fall as debt will get more expensive, and that's the fundamental problem here. The yen carry trade no longer works. It is unwinding, so now all of that artificial wealth is starting to disappear because at the end of the day, none of it was real anyway. Now, there are essentially two reasons why the yen carry trade is unwinding. And the first is related to interest rates in Japan, the difference between those rates in America as well. And the second is due to the yen's value itself and the exchange rate between the US dollar and the yen. And yes, before you say anything, I know that the yen's value is largely driven and influenced by interest rates and the difference between interest rates in different countries. But this is the clearest and best way to explain the yen carry trade unwinding, in my opinion. So we're going to go with it. So first of all, interest rates and the differences between interest rates in the United States and Japan. We are seeing Japanese interest rates rise much, much faster than US or American interest rates, obviously, US interest rates aren't rising, they're actually falling. Japanese government bonds have been scaling new peaks over the past month. On Thursday, the yield on the benchmark 10-year hit a high of 1.9%, surging to their strongest level since 2007. The 20-year reached 2.9%, a level not seen since 1999, while 30 years hit a record high of 3.4%, the highest since 1999 as well. So bond yields in Japan are rising as well, and they don't seem to be stopping in that rise. This is a very, very clear upward trend over the last few years, as you can see here. And even on a 3-monthly basis, you see that trend accelerating as well. Bond yields in Japan are rising, and all forms of Japanese government debt has seen its yields increasing. That relationship is being repeated across corporate debt and consumer debt in Japan as well. And this is a continued rise. It's seen in interest rates as well that are likely to increase. There's now an 80% chance of an interest rate hike by the Bank of Japan this month, according to markets. Japanese inflation remained well above 2%, while stronger than expected production and retail sales are likely to reinforce the Bank of Japan's confidence to hike interest rates in December. And so we're seeing inflation in Japan as well. And yes, 2.7% or whatever it's at the moment, around about that level, that's not a lot by our standards, and that's actually rather reasonable from the West's point of view. But for Japan, that is unprecedented. That's the highest they've seen in decades, and Japanese voters hate it. Inflation also obviously impacts bond yields and interest rates, right? The Bank of Japan knows that. Japanese people hate high inflation, so they're even more inclined to hike interest rates to fight it. And investors in Japan, they expect inflation to sit above 2% now for the entirety of this decade. So they're demanding higher premiums for Japanese debt, forcing bond yields higher as well. All of this basically to say that interest rates and bond yields in Japan are going up and they're going to stay there. But the yen carry trade, of course, only works with a difference in interest rates between Japan and the United States, or at least another market. And interest rates in Japan are moving higher, faster than the United States. Of course, the Fed is actually cutting interest rates at the moment, expected to continue cutting rates a little bit too. So the difference in rates is reducing, which means the yen carry trade isn't really working anymore, and there's far less profit to be made, so fewer investors are running the carry trade. Remember, the profit that you make from a carry trade is just the difference between interest rates in one country and another. Now, the second reason the yen carry trade is unwinding is risk. You see, interest rates alone aren't really enough to explain this massive change. As if there is even, say, a 1% difference in interest rates, you would expect the carry trade to keep working and be attractive for investors because you're not putting any up capital yourself, so everything is profit. It's just 1% pure profit on the debt you take out. Well, the problem is floating exchange rates, right? If you open a yen carry trade when the dollar's worth, say, 100 yen, as it was a few years ago, and then you close the trade today when the dollar is worth about 150 yen, the economics of that trade have suddenly changed massively. The debt that you owe is in yen, and it's in that same yen figure, but the dollars you traded for yen are worth more now, and so you trade your dollars back and you get even more yen and more profit than the interest rate differential. But what if the yen gets stronger, not weaker? Well, then the opposite happens. You trade your dollars with the interest in for yen, and it's not enough to pay off your debt. So suddenly you've lost money from what should have been a risk-free investment and trade. Now, floating exchange rates mean that this was always an issue and always a risk, but for almost the entirety of the last years, the yen has been steadily getting weaker day after day, week after week. So this really wasn't an issue, and it actually made the carry trade even more profitable for those taking it out. For the last couple of years, though, actually the yen has been incredibly volatile, and over the last year alone, the yen rose in value by 10% and then fell by about 10% again. Now, that 10% change in exchange rates, that's enough to make a supposedly incredibly profitable yen carry trade incredibly unprofitable. And because the difference between interest rates in the US and Japan is getting smaller, the margin for error is much smaller as well. And the yen carry trade is now 10 times more risky today than it was just a couple of years ago. Now, even if investors couldn't get caught out with just bad timing, interest rate hikes almost always make a currency more valuable and stronger, not weaker. Higher interest rates, right, that means more to be made by holding that currency, which means capital flows into the currency and prices, or the value, the strength of that currency, tends to rise as well. And the Bank of Japan is hiking interest rates while the US dollar is cutting interest rates. So many investors are betting that the yen is going to get stronger over time, not weaker. And those who aren't betting on a strong yen, well, they certainly aren't confident enough to put money on a weak yen either. And so suddenly the yen carry trade is completely dead in the water. Now, what's the impact of this on US dollar denominated debt and equity prices? Well, a 2.2 trillion US dollar exodus from American assets per year and a massive change in the pricing of these assets. Finding explicit numbers on how this will impact global markets is hard, especially considering that no one really knows exactly how large the yen carry trade is, as it's not something easily tracked. But if we're looking at something like an extra just 1% to bond yields for the US government over the next year as this carry trade unwinds, that alone is enough to cost the US taxpayer about $380 billion US dollars per year. As for asset prices, well, $2 trillion in outflows per year is bound to cause lost wealth far in excess of that number. Probably something in the region of $3 or $4 trillion in lost wealth per year. Now, as most of this is wealth in liquid markets, like publicly traded stocks or widely traded bonds, then the real impact to wealth and market capitalizations will be even greater, because so much of the wealth in the economy is illiquid and can't be accessed to counter capital flight back to the yen from the dollar. The problems with the yen carry trade are worrying a lot of people, and a question I've been seeing a lot in my comments over the last video on Japan is, how can I protect myself from this? And the answer is, you can't really protect asset prices from this for the most part, because all of our asset prices have been inflated by this carry trade. So as the carry trade unwinds, so will asset prices. What you can do though is focus on building up passive income instead, which isn't dependent on these asset prices and so won't be impacted by the yen carry trade unwinding. And that's exactly what I've been focusing on recently. I've been building up my online passive income streams, not through YouTube, not through these videos, because believe me, running this channel is not passive, but from another strategy I've been building and honing in on in recent months. Now, if you've seen my videos before, you've probably heard about my free cash flow masterclass, where I teach you how to build an online income to $3,000 a month guaranteed. And I've run a few of these classes over the last couple of months, and the response has been huge. So I do want to say thank you to everyone who's come and helped me make that a fun time. But also, I'm going to be running the final ever one of these free masterclasses this week. So it is now literally your final chance to get your free ticket. The class is really simple. It's 100% free, and in it, I give you the step-by-step tutorial you can follow to build an online passive income up from scratch to $3,000 a month guaranteed. You don't need to be a computer scientist to know how to code or have any experience in making money online or passive income before, and a foolproof step-by-step instruction manual to make it super simple to follow. Again, this is the last week I'm going to be running this free masterclass, so don't miss out. Click the link down below in the description to save your space now before it's too late. Again, it's the link down below in the description to save your spot for the final ever passive income masterclass I'll be running, so you can register and save your spot for that free class with the link down below. Now, in the other news I want to cover today, there is growing investor and market worry about the Magnificent Seven over-concentration, their overvaluation, and the AI hype they're seeing. And the most recent development surrounding this is with a firm called Yardeni Research, a global investment firm, and its founder, Ed Yardeni, who is ringing alarm bells about a potential Mag 7 bubble. Yardeni Research now recommends effectively going underweight the Magnificent Seven mega-cap technology stocks versus the rest of the S&P 500, expecting a shift in earnings growth ahead. We see more competitors coming for the juicy profit margins of the Mag 7 and expect that the productivity and profit margins of the rest of the S&P 500 will be boosted by tech. Every company is evolving into a technology company. The strategist said that it no longer makes sense to continue recommending overweighting the information technology and communication services sectors in an S&P 500 portfolio after having kept that weighting since 2010. The firm recommends market weighting of the two sectors by adding to overweights in financials and industrials and overweighting healthcare as well. So Yardeni Research have had an insane previous 15 years, basically stating that their strategy is invest in the S&P 500, but with a heavier weighting on big tech, and they've been winning out massively. Obviously, the biggest winners over the past 15 years have been the big tech companies, without a doubt. Microsoft and Apple and Google and Tesla and Nvidia and the like. And Yardeni Research's strategy massively outperformed the S&P 500 over that period, almost seeing twice the returns. And now, for the first time in 15 years, Yardeni is saying the opposite. The tech is overvalued, the hype doesn't make sense anymore, and their strategy has now been flipped on its head. They're now saying that we should be investing into the S&P 500 with an underweight tech sector, instead focusing in on industrials and financials and healthcare. And his reasoning is that the tech-focused companies like Google and Apple and Nvidia, they're all overvalued and they're going to struggle to see growth high enough to meet that overvalued nature, but also that the entire world is sort of becoming tech anyway. Healthcare companies, right, they're becoming more and more tech focused, and the same goes for financials and industrials. They're all pursuing traditional tech ideas and strategies, like looking for long contracts, giving stable monthly recurring revenues and low marginal costs through software. Investors are rotating out of the technology behemoths that drove virtually all of this year's 16% advance in the S&P 500 and snapping up shares of risky small companies and old economy transportation names that have been lagging all year. Since US stocks hit their near-term low on November, the Bloomberg Mag 7 price return index has gained 6% compared with an 11% rally in the Dow Jones and a 10% advance in the Russell 2000. The rotation comes as investors increasingly question the lift-all tech boat's nature of the AI trade, with heavyweights like Nvidia and Microsoft seeing rallies stall out. The optimism that the US economy is set to accelerate in the first half of next year has seen traders more willing to pile into value stocks at the cost of tech. So what this means is that Yardeni isn't alone in this idea either. This is backed by the markets as a whole. Mag 7 stocks have increased in value by 6% over the last 6 weeks, whilst the Dow Jones increased by 11% and the Russell 2000 by 10%. Traditional companies now look undervalued, profitable, and a good deal, and the markets are starting to recognize that, and it's shifting. Notably, we are not risking everything on AI futures anymore, as no one really knows if they're actually going to amount to anything. The Mag 7 merits special caution as they're competing more aggressively against each other, and they've got more competition coming out of nowhere. In particular, Yardeni cited recent doubts about OpenAI's dominance as well as the emergence of China's DeepSeek earlier this year. The Mag 7 really is the focus of the big issue here. Yardeni Research is less concerned with other more stable, less overvalued tech companies, but Mag 7 valuations are just too insane to ignore, and what's being priced in by the markets just isn't really realistic or reasonable anymore. In particular, the fact that they're all fighting for the same thing, right? A single AI model that's better than all the rest, which is then used to replace huge amounts of human labor and can be sold to any business employing people to type on a computer. In reality, it's incredibly unlikely this is going to be met at any time soon at all. And even if it is, only one of these companies will win out and the rest will lose. But they're being priced as if they will all win out and none of them will lose. OpenAI is inflating the values of all of these Mag 7 stocks through their circular deals, and I'm sure you no doubt have already seen about, but even they aren't the best AI company anymore. Gemini, which is Google's AI, is better in my opinion in almost every way, and it's almost as popular as OpenAI as well, with 650 million weekly users compared to OpenAI's 800 million. And then you have to consider things like DeepSeek, China's most famous and best AI model. Putting 44% of your money right now into these tech or AI hyped up stocks is incredibly risky, and that's the current weighting for the S&P 500 right now. So really, this all makes perfect sense that even the biggest tech bulls around, who have been pushing tech as their #1 strategy for the previous 15 years, even they are finally now saying it's too much, it's too overvalued, too much risk, and it's time to change. Now, the final piece of news I want to cover today is the news of Trump allowing Nvidia to export some of their more advanced computer chips to China in a really big reversal to their earlier trade policy, but also China's decision to sort of spit in the face of Trump's peace offering here, saying that they're going to be placing limits on these new highly advanced chips that China hasn't had access to before. Donald Trump will allow Nvidia to export its H200 chip to China in a move that has sparked concern amongst US security officials and lawmakers over Chinese access to advanced technology used for AI. In a post on Truth Social, Trump said he had told China's president that the US would allow Nvidia to ship its H200 products to approved customers in China under conditions that allow for continued strong national security, and that President Xi responded positively. Trump added that 25% of the dollars will be paid to the US without giving details of the arrangement. He said the same approach to allowing chip exports would apply to rivals like AMD and Intel. It had already been reported that Trump had allowed and agreed for Nvidia to export a less advanced chip called the H20 to China after Nvidia's CEO agreed to give the government 15% of their revenues, and AMD had a similar arrangement. So Trump is allowing these H200 chips to finally be exported to China in exchange for some sort of tariff or tax agreement where the US government seems to profit directly from this sale to the tune of 25%. Now, we've already seen a similar deal worked out with less powerful chips in the past, where Nvidia would pay an extra tax of 15% of the sale price to China. Now, why is this important though? Well, because China does not have advanced computer chips and hasn't for a few years now. This here is a graph showing you Nvidia's computer chips in yellow versus Huawei's, China's best chip manufacturer, in pink. And the further to the right and the higher up these yellow points are, the better the chips. And you can see far and away that actually China is really, really far behind in this space. This here is the H200 chip, and this is the best one that China has so far. So Huawei provide the best chips to China in the entire country, and the H200 chips are so much better than anything China can make, but even then, they're not even 50% as good as the best chips being put out by Nvidia on the market right now. So when it comes to the AI race that is getting a lot of talk about recently, the chips that you run the AI on are probably just as important, if not more important, than the AI, the software themselves, because these better chips, it equals a quicker AI that can process more faster and do it to a better degree, but it also means that they're more energy efficient when they're processing this AI, which makes the AI more affordable and less expensive to run. So in reality, we can make the AIs we have right now 10 times better by letting the AI run for 10 times as long and run or use as much as 10 times the energy. But that's not really an improvement in AI, that's just brute forcing more results instead of better results. But when we use better chips, we see the AIs actually improve themselves. Now, the West is so far ahead of China on chips that they simply cannot compete in this AI space whatsoever. China knows this and they are worried about it, which is why the CCP launched export controls on rare earth metals. In that sense, China is the worldwide clear leader in extracting and processing rare earth metals, essential for manufacturing loads of high-tech products. So China, they have a huge amount of leverage in the raw material space, and the United States, they have a huge amount of leverage in the technology space. And they've both been trying to stop the other from advancing by limiting their access without hurting their own advancements through retaliations. Trump now letting China access those H200 chips will help China a lot with their progress in computer science and AI, but there's been a lot of criticism for this, I think for understandable reasons, as if China wins the AI race, that's a massive threat to everyone in the West. But strangely, the CCP don't seem to see this as much of a peace offering from Trump, and they're not too happy about it. Beijing is set to limit access to Nvidia's advanced H200 chips despite Trump's decision to allow the export of the technology to China as it pushes to achieve self-sufficiency in semiconductor production. According to two people with knowledge of the matter, regulators in Beijing have been discussing ways to permit limited access to the H200, Nvidia's second best generation of AI chips. Buyers would probably be required to go through an approval process, submitting requests to purchase the chips and explaining why domestic providers were unable to meet their needs. So China clearly doesn't want every single company in China to buy Nvidia's better chips for cheaper. They're going to limit which companies can and can't buy them and how much they can buy. Why? Because the Nvidia chips are literally better. They're cheaper, they're more efficient in every way. And because China is scared that if every Chinese company starts buying these Nvidia chips, then Chinese chip makers will go out of business. And then in the future, Trump can just cancel exports again, and then China has no domestic industry to fall back on, and they're in an even worse situation than before. So China's trying really hard to build a domestic industry to beat America, not to rely on them. And so far, they have failed to do that in recent years. But if they succeed, again, this is genuinely a massive threat to us all. There is real evidence that China needs these chips, though, so they aren't going to block all of them. What is that evidence that China is actually rather desperate for these chips? Well, they are smuggling them actively. The US Department of Justice has detained two men for allegedly violating export control laws by attempting to smuggle at least $160 million worth of Nvidia AI chips to China. A third person has already pled guilty to this. The department alleges that the men operated a smuggling network that spanned Houston, run by one Chinese man, and several warehouses, which replaced Nvidia labels from H100 and H200 chips, so some of the chips that are now going to be able to be exported to China, with a fictional brand before shipping them over. So clearly there is huge demand for these better chips, so I would still consider this a bit of a win for China, even though the Communist Party, they aren't going to be allowing these chips to completely flood the Chinese market. Now, that is it for today. If you would like to let me know your thoughts on this new style of video, I'd really appreciate that, of one main topic for the day and then a couple other interesting things that popped up, a more news-based format. Tell me if you like it or not. My aim with this format would just be to post daily, at least for, say, Monday to Friday, so I'd have more content for you. Make sure to register and save your spot for my last ever passive income masterclass this week, of course. The link will be down below in the description. It will take you to a free registration page, but as of next week, I will literally never be running this free class again, so don't miss out. And if you don't want to miss out on my future videos, make sure to subscribe. But if you really want to help me and my channel out, send this video to someone else. Click the share button, send this video to a friend, a family member, a co-worker, or someone else, and help them see the truth as well. OpenAI, the $500 billion AI company that's been accused of essentially mass fraud and lying to investors, has just declared its very own code red, coming straight from the founder and CEO Sam Altman. Now, new data is emerging showing OpenAI to be losing its grip on the AI market, with Google coming out on top.